Hello and welcome to Daybreak Asia, coming to you live from New York, Sydney, and we're counting down to Asia's major market opens.
The top stories this hour. Asian stocks are set for early gains ahead of a US holiday. Traders are mulling that jobs report supporting bets that the Fed is nearing the end of its tightening cycle. Country Garden said to have made a coupon payment on a ringgit bond after winning approval to extend an instalment on a separate yuan note. Plus, SoftBank lining up some of ARM's biggest customers as strategic investors for the chip designer's multi-billion-dollar IPO.
Take a look at how U.S. futures are trading early in the Asia Monday session. We're seeing a little bit of downside pressure, but pretty muted after the S&P 500 saw its best week since June. Of course, we are in a Labor Day holiday weekend here in the U.S., so we're heading towards thin trading. But when it came to the Friday session, it was interesting because U.S. stocks rose, but they faded an initial rally as bond yields also started climbing. We had a strong manufacturing number offsetting some of that optimism from the jobs data, which actually showed more of a controlled cooling that perhaps could lead to the Fed pausing on its tightening again in September. We're watching WTI prices because we're extending those gains above that $85 a barrel level. This, of course, after 7 sessions of gains already in the New York session. We finished at the highest level since November, and it's really to do with those supplies and OPEC Plus efforts to really tighten those global flows. But at the same time, Heidi, of course, we have stimulus measures from China, and that's leading to more optimism about demand.
Yeah, and of course that sort of broad-based speech from Xi Jinping as well, really talking about this, managed opening up, high-quality growth, a lot of which we've really heard before. I'm not sure whether it adds much to the optimism over that recovery. But this is a picture as we set up across the opening here in Asia. We are seeing, of course, at the start of RBA decision week, as well as GDP numbers expected out of Australia. Aussie stocks looking modestly higher, about 0.4% to the upside. Not expecting, and in fact, all but one economist that we spoke to here at Bloomberg are expecting the RBA to hold for that third straight meeting. Borrowing costs here are sitting at about an 11-year high, and that broad trend when it comes to the data we've had recently, including the inflation numbers, suggesting that we may have hit terminal rate when it comes to the RBA. Watching Kiwi stocks, we're seeing a little bit of downside there. The major parties beginning their campaign going into that mid-October election over the weekend. Nikkei futures looking pretty modest at this point. Let's call that flat. And China futures are the ones we're looking at. A little bit of optimism, as you mentioned, 0.1% as we get sort of more of that piecemeal supportive measures from the government. But of course, it really just comes down to what we see with the developments in the property sector.
Yeah, and we continue to watch a distressed Chinese builder Country Garden. Sources now saying that the company told creditors that it has wired the coupon payment for a ringgit-denominated bond due Monday. Late last week, Country Garden also won approval to extend a separate maturing yuan bond, helping it avoid a first-time default. For more on this, let's bring in our Shanghai Bureau Chief, Charlie Zhu. Charlie, Country Garden barely keeping its head above water after being, just a few months ago, China's biggest developer. Where are we at?
So the ringgit bond news you just mentioned is pretty significant, but in terms of dollar amount is pretty small. So as an investor or creditor of the company, they should be looking beyond the headline. So bear in mind, this is a company just posted nearly $7 billion in record losses last year, and at the same time, the company warned that it may have, it may have problem meeting its financial obligation if the financial performance continue to deteriorate. And also, it said the company is facing material uncertainties that may raise its concern over its ability to continue as a going concern. So pretty serious warning. So, the company has a total of $35 billion in debt on its book, and including $15 billion maturing in the next 12 months. And the company also said, it will be able to meet its financial obligation, if the its sales continue to, if sales recover, and also its talks with creditor continue. Whatever in the capital market, investors have shown pessimism of their company's outlook. Its stocks have fallen nearly 70% from its peak, and also the dollar bond of the company is trading slightly over 10 cents on the dollar. And because of that, the overall junk dollar bond market offshore, which is mostly issued by Chinese developers, are trading at distress level. It's at the lowest since the beginning of this year.
Country's biggest, right? Is there any idea of what the kind of policy or rescue end game might look like for not just Country Garden, but the broader sector? Because there is this view that, you know, is it too big to fail, but also perhaps too big for the government to be able to save?
Yeah, the Chinese government has realized the problem in the property market is threatening to drag down the whole economy. So that's why over the past few months you have seen a series of measures from lower borrowing costs for home buyers and also threshold for a down payment threshold for purchases. However, the sales, has not picked up yet. It's because investors' confidence remained low following 3 years COVID restriction. They are not confident about their future income, and also, the job, the market is all doom and gloom. Youth unemployment rate is about more than 20%. Pretty scary. Last week, the policy announced by the Chinese government to lower the interest rates of existing mortgage is a big move. And over the weekend, state media reported that there is some renewed interest in home purchase. However, it takes some time to show whether there's a genuine buying interest. Traditionally, September, October is a strong month for property sales. So let's wait and see.
Our Shanghai Bureau Chief there, Charlie Zhu. Staying with China, and the Chinese President Xi Jinping has vowed to continue opening up the world's second largest economy while pursuing a development path that's on the country's own terms. Let's bring in Bloomberg's Asia Economy Managing Editor, Malcolm Scott, who joins me here in Sydney. I mean, this is sort of a rehashing of the same kind of sentiment that we've often heard from the leadership. At a time like this, though, do these sort of sweeping statements help for you?
Well, I guess they can't hurt, right? It's far better this than saying, no, we're closing up shop or anything like that. So, we wouldn't expect those comments, and we certainly didn't get them. Whether there's anything really new in these comments from Xi Jinping, that's to be debated. There was maybe some specifics around the services sector. There was comments around opening up, particularly in telecommunications, I think in legal services, tourism, those sort of areas. So maybe there's some specifics to follow there. I'm not too sure. But, the overall sentiment is very much echoed by Xi Jinping very often at these sort of events where he'll talk about Chinese modernization, opening up, high-quality development, all those sort of catchphrases. The problem is, as the European Chamber of Commerce have said, there's a bit of promise fatigue going on, especially among international investors. They want some specifics. So as Charlie mentioned, we're starting to see those specifics on the policy front in terms of property. Maybe more specifics are needed on terms of the opening up front as well.
Also, better economic data wouldn't hurt. What are we expecting from China's August trade numbers later this week?
At least things shouldn't get any worse, if not better. The export and import numbers due Thursday are likely to still be in the red, but maybe the declines are going to moderate somewhat. And the same can be said for the price data, which comes on Saturday. Consumer prices, we don't have many of the economists back with their forecasts yet, but the ones that are in are predicting positive prices, which is a good, short-lived time in deflation there. And on the producer front, it also looks like some of those negatives should moderate a little bit. So, that certainly would help restore some sort of confidence. And as Charlie said, on the property front, they've done a lot. If we can get some better news on the export front, which is the other big drag on the economy, then put together those two things might start to underpin confidence a little bit more than what we've seen in recent weeks.
Bloomberg's Asia Economy Managing Editor Malcolm Scott there joining us from Sydney. Still ahead, accredited Agricole joins us to explain why the weaker yen has acted as a, quote, reverse plaza accord for Japan, helping revive the economy's attractiveness to investors. This is Bloomberg.
Thursday.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
Welcome to Daybreak Asia. Here's a look at key events we'll be watching this week. China's fragile recovery remains front and center, with trade and inflation data likely to keep pressure on policymakers for more stimulus. Thursday's trade report is expected to show exports and imports contracted again in August. CPI numbers out next weekend may show continuing deflation. Elsewhere, South Korea's GDP for the second quarter and inflation print for August are due Tuesday. On the same day, the RBA is set to keep interest rates unchanged at Governor Philip Lowe's final meeting. Southeast Asian leaders will also be gathering in Jakarta for the ASEAN summit, Heidi.
Yeah, and on Wednesday, Sherry, Australia is set to release its second quarter GDP numbers. The Fed's Beige Book will also offer some anecdotes of recent US eco activity. For the North, the Bank of Canada is widely expected to hold rates steady. And on Thursday, back in Australia, we'll see the release of trade numbers. Malaysia is seen standing pat at its rate decision, and initial jobless claims out of the US will give us some colour on the labour market on that same day as well. To wrap up the week, Japan will announce their final second quarter growth figures. We'll also be watching the G20 summit in New Delhi. And of course, those Chinese and Russian presidents are set to be notable no-shows. And that is your week ahead. Our next guest says China will probably reach its growth target of around 5% this year, but structural pressures in 2024 and beyond are perhaps more worrisome. Gary Ng is a senior economist for APAC thematic research at Natixis CIB. He joins us now from our Hong Kong studio. Gary, great to have you with us. So if I take a step back, does that mean you see the more worrisome issues with the Chinese economy at this point to be the structural slowdown as opposed to the cyclical slowdown? Do you think it's more the former than the latter?
Well, indeed, I think if we look at what happened in the Chinese economy right now, there is clearly pressure from a cyclical side, from manufacturing and also on consumption. This is probably something that can improve a bit, in the next few months. However, we're also seeing some structural trend in terms of the weaker consumption confidence. It's not something that can be reverted that easily, especially on the purchases of goods. And there are indeed also the signs of balance sheet recession in the property sector, even though there are actually more policy support from the government recently, but we haven't really seen a very strong rebound in the home sales. So therefore, I think the weak confidence in both properties and consumption are probably something that is more structural, that calling for more government support, because otherwise, I mean, this will take basically be quite costly down the road into 2024 and beyond.
At this point, what do you think the most effective policy measures would be from the government? Do you think that something like direct payments to households is something that's required?
Well, I think if we look at traditionally the different type of government policies, of course, we have already seen the rate cut and also unleashing more liquidity from the monetary side. But from the fiscal side and also from the regulatory relaxation side, we haven't really seen too much in a way that is big enough to actually revert this market sentiment. So therefore, I think because of the concern on debt, and this is unlikely to change in the near future, the majority of the action will probably need to focus on the regulatory easing perspective. So it means that I think for household, definitely a lower down payment and also lowering or weakening the general regulatory environment to provide more room for the private sector to grow. This is something that is quite useful in the longer term. But however, beyond that, I also think China needs to provide a more private sector-friendly environment, and therefore I think ultimately it's all about income and growth outlook of corporate and household, and before we actually see the improvement in that, I think the pressure will still linger.
And Gary, let's talk a little bit about that cyclical rebound that we actually were seeing in Japan, because there was a lot of optimism over the Japanese economy, and yet last week we saw how firms were cutting capital expenditures. Is this a concern?
Well, I think indeed, if you look at the Japanese economy, it's as in many other places, it's probably growing in a more diverse place. On the one hand, of course, we have seen a weaker sentiment in the general manufacturing sector, but we still see this structural support in more firms actually try to move back to Japan and build their factories, especially in the semiconductor sectors, because of the supportive government policies. So even though there is a cyclical headwind from that front, I think it will not change the structural optimism driven by policy on that end. And on the other hand, of course, we continue to see this weaker yen fueling the export and also the tourism receipt. So I think this is something that is quite positive from the cyclical perspective, because Japan is still trying to recover in the post-COVID world and is actually lagging compared to many economies. So therefore, I think the weaker yen actually at this point of time is not too bad for the Japanese economy, and this is where we see this cyclical optimism for now.
Gary, is Japan's win South Korea's loss? I mean, they compete when it comes to exports. Those electronics manufacturers really on par when it comes to trying to target the global market. So I wonder, if Japan is doing so well, does that mean more headwinds for South Korean exports?
Well, indeed, if you look at the export structure in Korea and Japan, I think they have actually changed over time in the past 10 to 20 years. And in the past, we have seen a lot of cases of a lot of Korean firms, they trying to expand the investment, sell at a cheaper cost just to win the market share from Japan. But I think increasingly we see this more diverse export structure in Korea, focusing on different products versus Japan. Because if you look at what Japan export, especially in the tech nowadays, is really focusing on the upstream material and different equipment, etc. And this is not something that Korea would produce, because it's really about the more downstream memory chips and etc. So therefore, I think nowadays it's more like about the general downturn in the tech cycle, which may have, of course, affected both. But for Japan, I think they have already moved to the focus on the more upstream products, which is quite different from Korea. So they can actually be more complementary going forward than only competition.
How strong is South Korea's economy right now? Because those inflationary pressures that seem to have abated could come back again in the numbers that we're expecting this week. And if that's the case, the BOK will have to remain hawkish.
Well, indeed, if we look at how the Korean economy is performing right now, if we look at the inventory cycle, definitely is in one of the worst position versus some of the tech competitors, such as Japan, as we discussed, and also Taiwan, because of its focus on memory chips and also the competition from China as well. But I think what worries me beyond the export side in Korea is also the slowly decelerating consumer sentiment driven by this ongoing high interest rate environment and the spillover from export. So I think this is really something that will continue to pressure the Korean economy from the sector perspective. And it's very hard for BOK to actually hike rate further, considering this sluggish export growth together with the mounting household debt and the weak consumer sentiment. So generally, I think compared to many other countries in Asia, Korean central bank seems to have a higher tolerance to inflation, and also because they need to consider this external risk, I think this will actually stop them from hiking further unless there is really strong inflationary pressure coming back.
Gary Ng, senior economist for APAC thematic research at Natixis CIB, of course, on a very busy week for Ecodata out of Asia. You can get a roundup of all of these stories that we've discussed in today's edition of Daybreak. Terminal subscribers go to DayBgo. Also available on mobile in the Bloomberg Anywhere app. You can customize your settings so you only get the news on the industries and the assets that you care about. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
SoftBank is said to have lined up some of ARM's biggest customers as strategic investors for the chip designer's IPO. They include Apple, NVIDIA, and Intel. For more, let's bring in executive editor for Asia Technology, Peter Elstrom. Peter, so where are we at in terms of ARM's IPO?
Well, it's finally happening. ARM had been a public company before SoftBank acquired ARM for $32 billion. It's looked at a number of different strategic options for it. It tried to sell it to NVIDIA at one point, and now ARM is hitting the road for its roadshow, and it's talking to investors. The news that we have today is that they do have these strategic investors jumping in to put money into the offering. That's Apple, Intel, NVIDIA, as you mentioned, and Samsung, a few others also. They're putting in this money as they're customers of the company. They're supporting the offering, and that will give them a bit of momentum as they go and they start talking to investors about raising this money. This is likely going to be the largest IPO of the year. They're looking to raise $5 to $7 billion at this point. At one point, they were looking to add $8 to $10 billion, but it's probably going to be the biggest IPO of the year. But now they have to go out and talk to investors about it and see what kind of feedback they get beyond these customers that already know the business quite well.
But just getting the
What does it mean?
Oh, sorry, go ahead, Heidi.
Sherry, sorry, I just want to jump in and ask, I'm curious what this means for these backers, for ARM and the broader tech industry. Are there implications there?
Well, it's a vote of support for ARM. ARM sells designs that are sort of templates that go into chips. So chip makers buy these designs, they license them, and then they put them into products. So those are Qualcomm, NVIDIA. Now, tech companies that make their own chips like Apple are also using these designs. ARM has been very, very strong in the smartphone market, but the smartphone market right now is stagnant. It's not growing nearly the way it had been in the past. So ARM is trying to expand beyond that into some of these key new areas, including artificial intelligence, servers, cloud computing, all sorts of growth areas where they think there's more potential. So the key for them is being able to move into that territory and benefit from it and reap the kind of profits that they hope they can in the future.
What does it mean for SoftBank more broadly?
Well, this was one of the big bets by SoftBank founder Masayoshi Son. When he invested in the company, he had high hopes that ARM was going to be his window really into growth areas like artificial intelligence, the Internet of Things. It hasn't worked out quite the way that he expected. The company has not grown as much as he had originally anticipated. It has not been kind of that window. Again, he tried to sell it to NVIDIA before, and so the IPO is a bit of a backup option. He has been very involved in the operations of the company. He's been trying to help with this expansion beyond smartphones into some of these new growth areas for the tech industry. And at this point, we've seen some modest growth at the company in terms of revenue and profits, but it has to invest quite heavily. Beyond that, it has a pretty big risk factor in the IPO prospectus where it talks about what's happening in China. ARM China is actually the biggest revenue generator for the company at this point, but it faces all sorts of geopolitical issues in that market where they're trying to grow, they're trying to sell to the customers in China, but there's a lot of tensions between the U.S. and Beijing that create difficulties for that unit.
Our executive editor for Asia Technology, Peter Elstrom there, and SoftBank one to watch as we get into the start of trading today. Let's get some of those other corporate stories that we're following. India's richest banker, Uday Kotak, has resigned as managing director and CEO of the lender that he founded, Kotak Mahindra Bank. His resignation on Saturday came earlier than expected, and in a letter, the billionaire cited personal reasons for the decision. Deepak Gupta, who's the joint managing director, will now take over as interim CEO until the end of the year. Saudi Aramco is reportedly considering selling $50 billion in shares in what could be the largest offering in capital markets history. According to the Wall Street Journal, the new offerings will go up on the Saudi exchange to avoid any risks associated with an international listing. The report cites sources saying the timing of the deal hasn't been confirmed, but it could happen by the end of the year. Mercedes is intensifying its bid to challenge Elon Musk's Tesla. The automaker has unveiled an EV concept car with a longer range than any Tesla model on the market. The sedan, which is near production, can go over 750 kilometres on a single charge. Mercedes is under pressure to bolster the lineup following disappointing sales in China, which forced a cut to prices. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. Aon's advanced analytics and expert insights put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
If you average the last 3 months, it's about 150,000 jobs each month being created. This is the transition from the breakneck speed of the fast recovery we saw initially.
The unemployment rate, finally, that stubbornly low unemployment rate finally ticking up, I think is good news, but you have to be careful, right? The labor market can be a real slippery slope.
I think the Fed should be done. I certainly think, given this number, unless you got something very significant on CPI, I think they're not going in September.
You're seeing the kind of Goldilocks scenario that the Fed wants. I think it'd be really unlikely that they're going to move in at the next meeting.
This was the report that the market was looking for.
We're on track for a soft landing, and the economy that still chugs along. That kind of fall to a technical recession doesn't look likely as of now.
Bloomberg TV guests reacting to the August jobs numbers out of the U.S. and that data showing that U.S. hiring picked up in August as wage growth slowed, offering a mixed picture for the Fed of both resilience and moderation in the labor market. Let's get more from Bloomberg's Vonnie Quinn. Vonnie, some have called this a controlled cooling of the labor market.
Well, that's what the Fed is looking for, and that's what the Fed hopes is happening. But there is still that question over long and variable lags, and some on the Fed would have a different opinion on what a long lag and a variable lag is than others, and that's still the bifurcation, Sherry. Also, the fact that we're waiting on more data. But that jobs report did show a good picture depending on who you are and who's looking at it. So more jobs created than expected, but then some other little tiny cracks, which may also be good news for the Fed in terms of the fact that the participation rate was up, which meant more people were looking for jobs. We also had hourly wage growth slowing, as you can see, and that was a notable slowing in that growth. And we also had a revision to some past prints. They were revised down once again. And then you had the bond market, which reacted. And if you think about it, since last Monday, we're actually down about 20 basis points, even more in some cases. But across the curve, it's been a 20 basis point move. So the bond market clearly thinks that this is the last stumbling block to the Fed being finished with its hiking cycle. If you think about it, it was the resilient labor market that had everybody scratching their heads. If the Fed was trying to slow the economy so much, why was the labor market holding up so well? Well, now, as Bloomberg Economics puts it, the dual mandate is more in line with itself, the balance of risks to either maximum stable employment and stable prices is pretty sort of in the main pretty even right now, and that has the bond market thinking that, yep, we're absolutely done. Now, as I said, not everybody on the Fed believes this. They're a little bit wary that perhaps disinflation is not here to stay and that we could see an acceleration in inflation again, or just other data that would indicate that the Fed shouldn't be done. Take, for instance, Loretta Mester, who spoke on Friday after the jobs report at a forum in Germany. Have a listen to what she had to say, because she talked about managing the risks and particularly, and I'm quoting now, the intertemporal costs of over-tightening versus under-tightening monetary policy.
Although there has been some progress, inflation remains too high, and the FOMC is committed to moving inflation down to 2%. The monetary policy questions are whether the current level of the Fed funds rate is sufficiently restrictive and how long policy will need to remain restrictive to keep inflation moving down in a sustainable and timely way to our goal of 2%.
As you can see, as she's repeatedly suggested, she still has her doubts that inflation is going to remain benign. Obviously, we'll continue watching the data, and there is more data before the next Fed meeting. But if you dip into the Bloomberg, you'll see that the bond market has pretty much almost fully priced out another rate hike. There's less than a 50% chance, at least, of another rate hike for the rest of this year. And if it were to come, it would probably be in November after we've got some more data. However, they have fully priced in, bond investors, a quarter-point cut by next June. So what you now see is, and we heard some of it there in the introduction, you now see some of the major bond investors advising what are going to be the trades, right? So steepeners for the most part. So we heard from Jeff Rosenberg just in that spot there from BlackRock talking about this leading up to restrictive policy for longer, not higher for longer. In other words, we're going to stay where we are. We also have George Goncalves from MUFG saying this will favour the front end versus the back end. He thinks 2-year yields could go down to 4.5%. And then the head of rates strategy at SocGen, Subhadra Rajappa, says the trade to be in is steepeners. Either the market starts to price in more Fed cuts and the curve bull steepens, or the Fed stays on hold and the long end sells off. Either way, bull steepening is the trade.
What's next for these markets as they continue to try and read these tea leaves, Bonnie?
Yeah, well, we do have a week of Fed speak, Heidi, because after that the Fed goes into blackout mode again before the following meeting. And not that we're expecting anything in the meeting in 2 weeks' time, but the Fed obviously has to abide by the blackout period. We're going to hear a lot. We're going to hear from 7 Fed speakers, and Mike McKee will also be interviewing John Williams, the New York Fed president, on Thursday, so that will be one to watch out for. But we'll also hear from Susan Collins of Boston, Lori Logan of Dallas, Philly's Patrick Harker, Chicago's Austin Goolsbee, and the Fed Governor Michelle Bowman, as well as Atlanta's Raphael Bostic. They have a range of views. They will make them known. They will tell us what they thought of this jobs report and what they're anticipating. And then we get a raft of economic data as well, from final durable goods orders data from July to things like mortgage applications, which has been a very interesting indicator on the strength of the housing market and telling us, which pockets of the economy are doing well, how might we avoid a recession and so on. We'll get the trade balance, and literally we will be watching the bond market with eagle eyes from Tuesday. Don't forget, Monday in the United States is a holiday.
Bloomberg's Marnie Quinn there. Well, the acting US Labor Secretary, Julie Su, says that the latest jobs report boosts the case for a soft landing scenario. She also told us how the Biden administration trusts the process when it comes to managing negotiations with unions in a tight labor market.
This is exactly what you'd want to see if you're looking for a soft landing. This is if you average the last 3 months, it's about 150,000 jobs each month being created. This is the transition from the breakneck speed of the fast recovery we saw initially when President Biden first came into office to the consistent, steady, stable growth that you'd want to see in a strong economy.
The one really big axe here, Secretary, is what's happening with the unions. You have the Hollywood strike still ongoing, the actor strike still ongoing. You have a potential auto worker strike that could hit the big 3. You have trains, you have dock workers. There's a lot of union action right now. Is the White House in active conversations with these unions?
Right, so this is, we're continuing to see the effects of a tight labor market, right? We continue to have now unemployment at less than 4%. This is the longest stretch since the 1960s. And in a tight labor market, workers have more power. We've seen workers come back to the labor market and make choices about what it means to have a good job, a good family-sustaining job, a good job where they can, make demands to improve their lives and their working conditions. And the unions are a part of that. Now, you mentioned some unions where through those demands, they've resolved issues that were longstanding, that have raised wages and addressed certain conditions. You mentioned the ports. That's one area. We saw that with the Teamsters and UPS last month. We continue to see workers making these demands, and these are not just like a sort of an accident in an administration that supports working people. This is really part and parcel of workers being able to demand their fair share.
Sure, but when you take a look at the auto workers, for example, how does the administration avoid Sean Fain as the head of the United Auto Workers overplaying his hand? The increases in demands that union is asking are tremendous. 45% wage increase, 32-hour work week, things that many say are very unrealistic. And if those workers strike, we could be looking at a recession. That's what some are saying. How does President Biden handle that?
Yeah, I mean, we have definitely seen wage increases in contracts that have been signed. We've seen them wage increases, over 6-year periods, right? Multiple year periods. I think for a president who believes, as I do, in the collective bargaining process, we trust the process, right? We allow the parties to stay at the table. They are staying at the table. That's a good sign.
Yeah,
parties
but
are always far apart until they're not.
The Secretary, if they stay at the table and then eventually they strike, they don't get what they want, you're looking at 150,000 plus people out of work. That is going to have a tremendous drag.
Yeah, I mean, that's right. And so that's why we remain hopeful that the parties will resolve their issues. We trust their process to do that. Obviously, strike is a part of that, too. And everybody would love to see a path forward where the union and the employers do the right thing. These are, a moment in which union members are seeing historic profits coming out from, a pandemic. I think the parties have to remain talking.
That was acting US Labour Secretary Judy Su there speaking with Bloomberg's Alex Steele. This is a picture as we set up to the opening of trade this week here in Asia. And of course, a number of central bank decisions, including right here in Australia. We are expecting the RBA to stand pat for a third straight meeting. This will be Governor Phil Lowe's last decision before he hands over the reins to incoming Governor Michelle Bullock. We're seeing Sydney futures about 0.4% higher. They're really tracking some of the gains that we saw in the US. It is that long weekend for US markets, but we did see really that recalibration of Fed expectations and soft landing expectations on Friday, with those jobs numbers suggesting that the Fed could be nearing the end of the tightening cycle. That Labor Day holiday is not going to give much of a lead for a number of Asian markets at the start of this week, but modest gains are being seen at this point. Kiwi stocks looking a little bit to the downside. Nikkei futures now in Singapore just popping to a bit of a gain as we head towards the start of trading in Tokyo in just about 20 minutes time. S&P futures coming under a little bit of pressure. We do have much more to come here in Daybreak Asia as we really continue to look towards the bigger story, of course, for this region and perhaps globally, which really is what happens next with the Chinese slowdown. We did have some commentary from President Xi Jinping talking about the managed opening up of China, as well as more kind of incremental support measures for the property sector and broader economy. Much more to come. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
Demand in Japan's economy has outstripped supply for the first time in nearly 4 years. It's a sign that the economy is getting closer to achieving the lasting inflation sought by its central bank. Japan's Cabinet Office says the output gap, a broad measure of supply and demand in the economy, rose 0.4% in the 3 months through June. Let's bring in our next guest, who says Japanese policymakers could use the weak yen to their advantage to pull the economy completely out of deflation. Takuji Aida is Chief Japan Economist at Credit Agricole and joins us now from our Tokyo studio. Takuji, great to have you with us, and you're calling this sort of a reverse plaza accord. Explain this to us.
Yes, 1985. The Plaza Accord strengthened the yen from 240 yen to 140. But this time, FRB is tightening monetary policy, but the BOJ keeps easing. So the yen weakened up to 150 yen. we think this level, weak yen level, will strengthen Japan's corporate export competitiveness. And the government and Bank of Japan likely accept this weak yen level as a reverse Plaza Accord.
Takuji, demand, though, is also an important part of the inflation picture. If you have a weak yen, wouldn't that erode purchasing power for Japanese, and domestic demand would get hit?
I think corporate investment will increase rapidly going forward because Japan's corporate will regain export competitiveness. So production in Japan will increase. So this corporate investment, domestic investment, is very important to push up Japan's aggregate demand. So one of the reasons why Japan has a long-term deflation is weak corporate investment. That means that Japan's corporate saving rate was positive, and we need corporate strong investment to push up Japan's domestic demand.
Takuji, when you take a look at the reform measures that we've seen from the government so far, what do you think is most needed at this point as we see this kind of turning point for the Japanese economy?
Fiscal policy expansion to push up domestic investment. We expect the Kishida administration will have another economic stimulus measure in this fall to push up domestic investment, including DX, GX. That will push down Japanese corporate savings rate from abnormal positive territory to normal negative territory. Then Japan's, the weak domestic demand will be gone. Then Japan can get rid of the structural deflationary pressure.
And this is the idea of trying to create this virtuous cycle, right? Do you think the investment environment is becoming more attractive in a sustainable way? Is there still a risk that we don't see the virtuous cycle materialize?
Not only is weakened level, but also U.S.-China tension. Japanese production is coming back from overseas, especially from China to Japan. That will push up Japan's domestic investment. So this is a kind of a tailwind for Japan to get rid of structural deflationary pressure.
Are you concerned about the latest capex figures that we got last week, where we saw Japanese firms investing less than expected in the second quarter?
But in terms of the fiscal year plan, still corporate capex plan is very, very strong, and still labor shortages, corporate feeding labor shortages. So they have to put capital on the economy to ease these labor shortages. So we expect the capex will keep growing going forward.
Takuji, we've talked a little bit about the geopolitical tensions, right? What is the biggest risk when you take a look at the Chinese slowdown, and does that have a meaningful impact when it comes to, the sort of export strength of economies like Japan?
Two main risks. One risk is, of course, overseas economy. If U.S. economy is very weak, and also Chinese economy cannot get out of these stagnations, export demand will going down. So Japan's economic cycle will go down. So temporarily, Japan's capex momentum will be weakened. Then I think Japanese the cyclical recovery will delay. And the secondary risk is the tightening fiscal policy. Still, aggregate demand is not strong enough. If the Kishida administration tightens the fiscal policy, we expect Japan will go back to deflation again with a weak domestic demand.
Takuji, how big is the BOJ risk if the central bank does in fact tweak policy in a way that could strengthen the Japanese yen? Would everything that we talk about be at risk?
I think BOJ risk is the minimum. We think BOJ will keep easing to end the deflation completely. So we do not expect any monetary tightening next year. I think BOJ will tighten monetary policy in 2025 when the Japanese economy will make cyclical economic recovery with a global economic recovery.
Takuji, great to have you with us. Takuji Aida, Chief Japan Economist at Credit Agricole. You can watch us live and catch up on past interviews on our interactive TV function, TV Go. You can also dive into any of the securities or the Bloomberg functions we talk about. Joining on the conversation as well, you can send us instant messages during the shows. This is for Bloomberg subscribers only. Do check it out. It's at TV Go. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
New Zealand's two main political parties have launched their election campaigns this weekend, each promising to ease cost of living pressures and warning of dire consequences if the other side wins. For more, let's bring in Bloomberg's Tracy Withers in Wellington. So obviously cost of living is the key issue for these voters as we head to the polls on October 14th.
Well, that's right. It's economic management and the cost of living pressures with inflation running at 6%. And both parties have launched their campaigns at the weekend, just 6 weeks away from the vote, with differing ways of tackling that. The details from National came out last week. The opposition party and Labor previously announced cuts to sales tax on fruit and vegetables as one way of taking the pressure off.
So what's the mood overall in the electorate right now heading into this election?
It's we've had a quite a prolonged period of pre-campaigning, as you often do. I think at the moment, National, the opposition party, is polling 35 to 37%, and the ruling Labor Party has just dropped below 30%. So if those polls are to be believed, the opposition has got a fair chance of winning. However, as is always the case in New Zealand, it will need partners in a post-election coalition arrangement. And again, maybe National's slightly closer to getting that magic number, but obviously there's a lot of talk and debate to come before that's decided.
And obviously, spending, as you would usually see as pro-election sweeteners, is a sensitive issue given the still sensitive inflationary environment. Is there any money in the kitty, or I guess political willingness to do that?
Well, no doubt there's willingness, but in a word, there isn't much money. The economy is slowing and could face recession before the end of the year. Tax revenue's been hit. The government just last week announced that it wants to cut $1 billion a year from spending within government agencies and departments if it wants to get back to the surplus that it's promised. Still, as I mentioned, the government's promising to take the sales tax off fruit and vegetables. On the other hand, National's got quite an aggressive tax cut policy, which it says it can self-fund by adding levies on things like foreign purchases of houses and gaming. But the issue for the opposition is that they need to show that those numbers stack up, and as yet there are quite a few questions about that.
Bloomberg's Tracy Withers, they are joining us from Wellington, and we'll actually be speaking to New Zealand's Prime Minister Chris Hipkins on Wednesday as the election campaign gets into full swing. That's 1:40 p.m. Sydney time, 11:40 a.m. in Hong Kong. And these are some of the stocks that we'll be watching when trade opens in Korea, Japan, and Australia. Keep an eye on Lion after U.S. lithium giant Albemarle sweetened its takeover offer to $4.3 billion. Liontown says it's willing to recommend the latest bid at a 15% premium to Friday's close and has granted Albemarle due diligence. Insurers in focus in Japan, especially the parent companies of Tokyo Marine and Nichido Fire Insurance. Kyodo has reported that some of the major firms implicated in fixing premiums for businesses are suspected to have done the same for contracts with the Tokyo metropolitan government. We have the market opens in Sydney, Seoul, and Tokyo as we're seeing the Japanese yen seeing a little bit of strength against the U.S. dollar at that 146 level. This is Bloomberg.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
This is Daybreak Asia. We're counting down to Asia's major market opens as we're still in a long holiday weekend here in the U.S. We saw the S&P 500 seeing its best week since June. It was an interesting session, Heidi, on Friday because we saw the markets reacting to more optimism about the jobs report showing potentially a controlled cooling in the labor market, but strong manufacturing numbers, and we actually had bond yields rising and stocks being pressured.
Yeah, it was an interesting kind of mix of data wrap. It certainly reignites a soft landing scenario kind of debate and whether we're close to the end of the cycle for the Fed. And certainly questions are whether we're close to the end of the cycle and the terminal rate when it comes to the RBA. That's a decision that we're focusing on this week. But let's get you straight to the start of trading here in Asia this Monday morning. And in the absence, of course, we have that long weekend in the US. We are seeing Tokyo markets come online looking like this. And amongst the things that we'll be watching this week, of course, is any further policy measures that we get out of China. These have huge implications when it comes to trading partners like Japan. We're seeing a little bit of upside there. The Nikkei 225 coming online up by just about 0.3%. The yen really holding pretty steady at this point. 146 against the US dollar is where we're seeing the JGBs are really looking set to see a bit of a struggle. We're seeing that positive output gap as well as some auctions coming up there as well. China trade will be one to focus when it comes to just the eco data for the Chinese economy this week, I should say. And Sherry, if you take a look at, of course, one of the stocks we're watching, a SoftBank will be in focus given we're getting some really momentum when it comes to that IPO.
Yeah, we're really broadly watching the chip sector across Asia too, right? Take a look at how the Kospi is coming online, up 0.2% and extending gains that we saw in the previous session, although the Kosdaq is under pressure. Of course, we're watching the Korean won very closely as well because we had some strength last week, given the South Korea's exports in August dropped, but not as much as people had expected. So perhaps that slower demand from China not hurting South Korea as much as before. So we're seeing signs of a resilient economy. We do have inflation numbers out of Korea this week as well that we're watching. Right now, we're seeing a little bit of pressure on the Korean won. Heidi, not surprising given that the dollar hit that 3-month high as well.
Yeah, and those currency pairs will be one to watch in the session as well. Take a look at how the start of trading is shaping up in Australia. Of course, that staggered open, seeing muted upside when it comes to trading in equities. These markets, of course, these stocks, I should say, are still coming online. But the bond market is really something that we're focusing on. A noticeable outperformer during what's been really a pretty disappointing year across much of fixed income. But we've seen, obviously, one of the aspects is the RBA's slightly softened approach to taming inflation. We're expecting, of course, no move again in the meeting this week as well. But some of these concerns about China's lackluster economic performance is also lurking, potentially as more of a risk for Australia's economy as well. Of course, we depend, when it comes to trade, about a third of its trade on China. And on that note, though, we could see some optimism given that we saw the announcement of these high-level talks between Beijing and Canberra. Sherry.
Heidi, let's bring in our next guest, who says he's now spending more time looking at smaller markets for his Asia portfolio allocation. With us now is David Wong, Senior Equities Investment Strategist at AllianceBernstein. David, good to have you with us. Of course, the world is very much focused on what's happening in China, the eco data, the stimulus, the market's really not responding. Are we missing any opportunities out there in smaller markets?
Great question, Sherry. Thanks for having me on the show. We are, certainly going through a more difficult time in Asia than in other parts of the world. And when we look at equity markets, it tends to really be driven by earnings. And earnings revisions for Asia have been really pretty disappointing compared to most developed markets. And what we would advise investors to be doing right now, as you think about how to allocate one's portfolio in an Asian context, you have to look at opportunities that are not all completely synchronized and correlated. And that's why, from our perspective, some of the smaller Asian markets that often don't get that much attention, be it the Philippines or Vietnam, are actually, perhaps worth a second look at this time.
Is also your effort trying to avoid correlation a reason why you're suggesting investors across Asia also keep 2/3 of their equity exposure in the U.S., according to your notes?
Yeah, we do find that Asian investors in particular systematically, have this home market bias where they want to own Asian equities first. And that has been something that hasn't been great for their financial health, especially when we look at the 10 or 15-year Sharpe ratio, which has been far higher for U.S. equities at 0.5 compared to about 0.1 for Asian markets. And we do think that, especially at a time when earnings continue to be very resilient in the U.S. And where arguably you have tech actually coming out of an earnings recession over the past 18 months. This is a time where the U.S. equity market is perhaps almost in something of recovery mode, even as nominal GDP is dropping. On the other hand, when we look at markets in Asia, be it China or others, the double-digit earnings growth that we had seen forecast at the beginning of the year is probably more likely to be in the 0 to 5% range for this year.
David, how do you, paint the risk-reward construct for China, for investing in China now?
Well, I guess when you think of what drives equity markets, it's generally some combination of earnings and valuation. And on the valuation front, China does offer the benefit of not being very expensive at all, especially if we compare Chinese equities to its own home bond market, as we often do, say, with U.S. equities and the 10-year Treasury. However, I do think while earnings are continuing to slide and decelerate, this is an environment where you really have to be selective and find companies that are unlikely to be affected by some of the macro headwinds we're seeing in China, and where on a bottom-up basis we can find companies that are reasonably well managed and that offer revenue and earnings growth this year and going into next year as well. And we find some of these opportunities in select consumer names, be it in some of the consumer electronics manufacturers and brands in China. But we also find that performance is going to be dictated by what you don't own in a China context. And so avoiding some of the rougher parts of the old economy, we think is probably advisable at this time. But when we look at the Caixin PMI data, which is perhaps more focused on exporters compared to the domestic economy, the manufacturing PMI actually poked its head above 50, which is a sign that as some of the inventory drawdowns are coming to an end for various types of manufactured goods that are being exported, that is potentially an area of opportunity for investors in China as well.
David, we've seen some of the popular redirection of flows away from China into markets like India, into Japan, but given how extended certainly some of those popular markets are there other opportunities for that, I guess, even within an emerging market, Asia play?
Well, there's always opportunities on a bottom-up basis, but when we look at Japan, we understand why people may feel like it is extended, given how it has performed relative to its Asian neighbors. But actually, from a valuation and from an earnings perspective, especially earnings momentum, we're finding quite a lot of opportunities in Japan right now. And so given the abundance of earnings growth that you'd expect in a weaker yen environment, plus also the added tailwind of corporate reform, that is, I think, making Japan perhaps the most attractive opportunity of all in this region.
David, always great to chat with you. David Wong, Senior Equities Investment Strategist at AllianceBernstein. Well, still ahead, the annual ASEAN Summit gets underway on Tuesday. Ahead of that, we'll be speaking to the University of the Philippines Asian Center about the biggest sorts of frustrations between the bloc and China. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
Bloomberg's learned that the distressed Chinese builder Country Garden has told creditors that it's made a coupon payment due Monday for a ringgit-denominated bond. Late last week, Country Garden also won approval to extend a separate maturing yuan bond, helping it avoid a first-time default. Bloomberg Intelligence China property analyst Christy Hung joins us now from Hong Kong. Christy, so it looks like they're barely managing to stay above water. What's next?
Right. So Country Garden is absolutely not out of the woods yet. The ringgit bond coupon payment is still relatively small in size. And what matters more is it going to be able to be repay the dollar bond coupon payment in the next 2 days? That's the end of the grace period in order to avoid a default. And I think for Country Garden, even if it does, there's still sizable bond maturities coming up in December and January, and that necessitates the need of an offshore debt restructuring. For Country Garden, if there's any signs of repayment stress, it just suggests a downward spiral on the liquidity because of deteriorating sales as well as refinancing.
What about the fresh wave of policy stimulus? Is that going to meaningfully help at all?
Right. So for the central bank, introduce a minimum down payment requirement that's uniform across the country. That's good news for China's Tier 1 and strong Tier 2 cities, but that is just 31% of China's housing market. And I think what matters more is for the smaller cities, that's accounting for 2/3 of China's housing market. A lot of the down payment ratios has already raised to, 20%, raised down to 20% for first homes and second homes at 30%. So that's very limited room for extra easing in those cities. And, if we look at developers like Country Garden, Agile, most of the land bank are in smaller cities, suggesting that their sales are not going to benefit from these kind of policy stimulus.
Yeah, how have sales done so far, not only for Country Garden, but other developers as well then?
Right, so for the month of August, sales is still down 34% year over year, and we expect that kind of decline to persist through the rest of this year. With the policy stimulus, it might help arrest the decline, but not turn around sentiment. I think it doesn't matter how much the government is trying to make it easier for people to buy homes. That doesn't overcome a lack of confidence from the household's perspective. That's confidence on the home price outlook, on the economy, and on the health of the property sector.
Our Bloomberg intelligence analyst for China Property, Christy Hung there. Well, Chinese President Xi Jinping has vowed to continue opening up the world's second largest economy while pursuing a development path on the country's own terms. Let's bring in Bloomberg's Asia Economy Managing Editor Malcolm Scott here in Sydney. We've heard this kind of narrative many times before, haven't we?
Yeah, we have, but it's good to hear them again. Reassurance from Xi Jinping that the Chinese economy remains open to Western business. Of course, there's a lot of scepticism about that, especially with the regulatory crackdown on tech, and the slump in foreign direct investment into China speaks to that, and the real deterioration in conditions. So some welcoming words from Xi Jinping. They certainly can't go astray. Whether there's anything really new here, it's hard to say. There were some specifics about the service sector opening in areas like telecommunications and tourism. Maybe we'll see some follow-up details on that come in weeks and months to come. But look, that's very unsure. As the European Chamber of Commerce said last month, there's a real promise fatigue sort of feeling going on among the Western business community in China.
Malcolm, what are we going to see from China's August trade numbers later this week?
Look, they're still going to be fairly miserable, negative for both imports and exports. The consensus among the economists we survey show that some of those declines, however, on both fronts may moderate. Bloomberg economists' own team, though, they're a little bit more bearish on the outlook. They think that the export situation is still going to look fairly miserable. So we've got this big, giant growth driver in property that's spluttering, and at the same time, this big export engine is also spluttering. Not good news for confidence in China's economy. But if we do see some sort of baseline, some easing in declines after we saw that Caixin report on manufacturing come back positive on Friday, maybe this will start to at least engender some hope that perhaps the worst is over, maybe even on both fronts.
Malcolm Scott, Bloomberg's Asia Economy Managing Editor there. You can get a roundup of all of these stories that you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers, go to Day Go, also available on mobile in the Bloomberg Anywhere app. You can customize your settings so you only get the news on the industries and the assets that you care about. This is Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Welcome back. Here are some of the corporate developments that we're tracking. India's richest banker, Uday Kotak, has resigned as managing director and CEO of the lender he founded, Kotak Mahindra Bank. His resignation on Saturday came earlier than expected, and in the letter, the billionaire cited personal reasons for the decision. Deepak Gupta, the joint managing director, will take over as interim CEO until the end of this year. Saudi Aramco is reportedly considering selling $50 billion in shares in what could be the largest offering in capital markets history. According to the Wall Street Journal, the new offering will go up on the Saudi exchange to avoid any risks associated with an international listing. The report cites sources saying the timing of the deal hasn't been confirmed, but it could happen by the end of the year. Mercedes is intensifying its bid to challenge Elon Musk's Tesla. The automaker has unveiled an EV concept car with a longer range than any Tesla model on the market. The sedan, which is near production, can go over 750 kilometers on a single charge. Mercedes is under pressure to bolster its lineup following disappointing sales in China, which forced the firm to cut prices on some models. And Germany's biggest car show is getting underway in Munich, where car makers are showing off their next-generation models in the increasingly competitive EV space. Bloomberg's Oliver Crook reports.
We're here in Munich at ground zero of the Battle of the BEV, the battery electric vehicle. BMW, Mercedes, all launching their new concept cars, showing them to the market really for the first time. For these legacy automakers, really proving that they can stay ahead in an industry that is in full evolution. For the Chinese, if the Europeans are in defense, they're on offense. They're here, BYD, Zeekr, NIO, Xiaopeng, all to show the European market what they've got to offer, really working to break in to the international stage. And let's not forget about Tesla, revamped Model 3, cutting prices again, that price war, really turning up pressure for a lot of these legacy automakers that don't necessarily know how to make that kind of money on EVs. We'll be speaking to the European CEOs. How do they stay relevant? How do they stay ahead? And for the Chinese, how do they break in?
Bloomberg's Oliver Crook there at the IAA Auto Show in Munich. This is what we're watching when it comes to SoftBank stock in focus at the moment. We're actually seeing a little bit of downside. The SoftBank said to have lined up some pretty big backers, Apple, Nvidia, strategic ARM IPO backers there. Some of the biggest customers of ARM now being positioned as strategic investors for this highly anticipated IPO from the chip designer. Intel is another name that's being bandied about as well. Let's get in some more details with our executive editor for Asia Technology, Peter Elstrom, joins us now. Peter, what do we know? I mean, we have been watching and waiting for details of this IPO for so long now.
Yeah, it is finally here. We are finally on the verge of ARM beginning its roadshow. That will kick off this week. And of course, SoftBank has looked at a number of different options for this business. The chip designer it bought for $32 billion has been a high priority for Masayoshi Son for a while. He did try to sell it before to NVIDIA. That deal ended up not proceeding because it wasn't able to get regulatory approvals. Customers were also kind of unhappy with it. So now he is proceeding with this backup plan of taking the company public, and it has been a while. He's taking it public in a market that has been quite strong for chip stocks, especially stocks like NVIDIA. As you pointed out, now ARM's customers are putting some money into this deal. You have strategic investors, including NVIDIA itself, ARM, Intel, Samsung, a bunch of others. This is kind of a vote of confidence in the offering as SoftBank prepares to take it public. The valuation for the company they'd been looking at as high as $60 to $70 billion. Now it sounds like it's come down a bit since then to $50 to $60 billion. But the real test is going to be this week as they go on the roadshow, they talk with investors, they see what kind of feedback they get, and they figure out whether they're able to price it a bit more at the top end of that range or the lower end of that range.
Peter, does it help that they have such high-profile backers? And what does this mean for ARM? And also, what does it signal about the rest of the tech industry?
Yeah, it is a vote of confidence to have companies like Apple and NVIDIA putting money into this business. SoftBank is not going to sell a lot of the equity here. They're looking to sell about 10%, according to what sources have told us. So SoftBank is still very much going to be the controlling shareholder, even as it goes public. The real challenge ahead for ARM is that it's been the dominant provider of these chip designs for smartphones. Its designs are very low power. That's worked very well for companies like Qualcomm that are making chips that can't use that much power in a mobile device. Now ARM is trying to move up the value stack to do more with cloud computing, with artificial intelligence, with data centers that provide all sorts of services. That has been more of a challenge. That's really the home of companies like Intel and NVIDIA, which are very powerful chip players, and they use a lot of power, and the power-saving characteristics of ARM's designs are a little less critical in those areas. So SoftBank with ARM is trying to expand into those areas, and they need to show that they can get the kind of revenue growth that they would get if they're able to expand beyond that smartphone market that they've dominated for so long.
Peter, how much does this help for the broader, I guess, existential crisis we've seen at SoftBank, right? How much does it aid in the turnaround?
Yeah, there have been a lot of challenges at SoftBank. Of course, the challenges have really stemmed from Masayoshi Son setting up this vision fund. Originally, $100 billion that he was going to invest in startups. It ended up going to more than $140 billion. And he made a number of bets that really have not paid off. WeWork now is close to bankruptcy. They put in more than $10 billion into the company. They've had a number of other problematic investments in startups. So ARM is a chance for Son and SoftBank to recalibrate a little bit of that value, to get some cash to be able to go out there and make new investments. The company has been accumulating cash in recent quarters. It's been doing a bit better recently. It's also paid down some of its debt. So its balance sheet is looking pretty strong at this point. If it can raise some money from ARM, if it can get this into the market at a decent valuation, then that will give Masayoshi some dry powder to be able to go out, and probably he's going to cut some more deals.
Executive editor for Asia Technology, Peter Elstrom, there with the latest on that ARM IPO. Take a look at how European futures are trading in the early Asian session after we saw European stocks rallying last week and posting their best week since mid-July, really taking hints from where the U.S. headed, with that data suggesting that the Fed might be able to pause rate hikes and pause its tightening. And this, of course, the sentiment has been a bit subdued, Heidi, this week, given data also showed that drop in China's manufacturing activity, not to mention that the euro area inflation numbers stopped slowing in August. We do have more to come on Daybreak Asia. This is Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
There's a place where global markets are always open, where you can explore and discover innovative new offerings and hundreds of trading products right at your fingertips. That's SIBO, the exchange for the world stage.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
Take a look at how Asian markets are trading at the moment. We're seeing upside for most markets, with the Nikkei being led higher by real estate and energy stocks. And this, of course, as it continues to extend its longest winning streak since May. We're up for a sixth consecutive session. The Kospi is also gaining ground. We are expecting South Korea's inflation numbers later in the week, but we might see that 6-month slowdown in CPI trend in August being broken. The Korean won also holding steady at the moment at that 13.21 level, maybe a little bit of pressure against the US dollar. We're watching the ASX 200 headed towards that RBA rate decision. The expectation is for Philip Lowe's final rate meeting to be a hold. Kiwi stocks, though, seeing a little bit of pressure, and this, of course, coming as U.S. futures remain pretty muted at the moment. We are on a long holiday weekend here in the U.S. Bloomberg's latest MLife Pulse survey has found that the U.S. stock market rally could be strong enough to withstand another leg higher for bond yields. MLife strategist Mark Cranfield has more on the survey results. And Mark, of course, we had the best week since June for the S&P 500, and Friday's trading session was pretty interesting because really Treasury yields and were down first after the jobs report, then they were up because of manufacturing data, and that really pressured the stock markets. But what are we hearing from the survey?
Well, the Friday being directly before a long weekend, some of the moves are probably a bit exaggerated. So I think you can not take too much from what happened there. But what the survey generally shows is that investors are pretty sanguine about rising Treasury yields. They don't see it having a huge impact on the stock market. So people were asked if Treasury yields in the 10-year rose to 4.5%, what sort of impact would that have on the S&P 500? And people generally thought that the losses would be contained to less than 10% in the S&P 500 if that was the case. Of course, if there's some weakness starts to appear in the equity market because of high yields, it would probably be in the tech sector and in some of the real estate sector where the losses would be a little bit more pronounced. But then, of course, on the flip side, the banking sector would probably do pretty well. So overall, there certainly would be rotation. But the general view is that Treasury yields are mostly priced in, and that from here, we're not going to see too much concern to the equity market going forward.
Is the bond market still going to be, I guess, a source of pressure, or are we starting to see a little bit more resilience when it comes to the stocks-bond correlation?
Yeah, people are still pretty happy with this 60-40 portfolio setup. That people were questioning it last year, whether there was still a future for this familiar way of setting up a portfolio when bonds and equities were falling at the same time. It certainly seemed to jeopardize whether this still had a good place in general portfolios. But if you look at the way things have progressed since then, the equity market has been much more resilient. And even with the Fed raising rates to the highest in a couple of decades, it hasn't done extreme damage to the market. And of course, there have been the positive stories like AI, which will keep everybody very interested in certain parts of stocks as well. So overall, and as this survey also confirms as well, people still generally are in favor of the 60-40 portfolio, although maybe not as strongly as they were 10 years ago. But certainly it still looks as though it has a big place at the center of most people's strategy.
Bloomberg's MLife strategist Mark Cranfield there with the latest commentary. And you can, of course, get more on this story, all the day's trading analysis on our Markets Live blog. That's on the Bloomberg at MLive Ego. You can get a market rundown in just one click, and there's commentary and analysis from our team of expert editors, so you can get exactly what's affecting your investments at any given stage. This is Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Welcome back. Let's get you some top geopolitical news from around the world. Italy's foreign ministry is on a 3-day visit to China, discussing the possibility of his country leaving the Belt and Road Initiative. Before heading to Beijing, Antonio Tajani told us the investment pact has fallen short of expectations.
The message is very clear. We want to work with China. Is a competitor, of course, for us. We want to work in the Chinese market. We are ready for Chinese investment in our country, but we need a level playing field.
Italy's membership in the BRI has turned into a dilemma for the Meloni government after making it an outlier among